Welcome to Module 10 of the Master's Certificate in Technical Analysis. My name is Stu Wisson. This module deals with the cloud chart, the Ichimoku technique. This is a very recent discovery in the US. It was developed in the 1930s, but it remained in Japan. And it has been published in Japan since 1968, but it was only at the end of the 20th century that the Japanese really adopted it. Now it's coming to the Western world. So it's pretty cutting edge stuff and very interesting because no one really is acknowledged as an expert in the Western world yet. Now cloud charting, this is known as the Ichimoku Kinko Hyo. But Ichimoku means that one glance. Kinko is balance and Hyo is a bar chart. And it's concerned with giving you information quickly, and it's concerned with the balance in the chart and the way the prices go. The guy who invented it was a financial correspondent for the Tokyo newspaper. He started work on this in 1933 and got together a team of people to work on it because in those days they didn't have computers, quite obviously, and so if they wanted to go through those figures then they had to just sit with a pen and paper and work it all out. And from what he used to write weekly update articles in a journal called Shaito. It is a great financial journal, and he achieved a lot of success and fame from writing these articles, which were based on his research and his techniques. But he didn't tell anyone about how he did it until 1950, when he got together a small group of people and swore them to secrecy for another 10 years, but he told them. And then in 1968 he finally wrote a book. I believe it was in 7 volumes and very expensive, and he published it in 1968, and that's when it actually became available to the public. But even then it wasn't popularized until 1996, and the most famous book in Japan about the Ichimoku technique is a book called Susaiko, a book by Sosaki, translated variously as study of Ichimoku balance chart, or initial translation I believe maybe was table of equilibrium at a glance. The idea behind the technique is that time is valuable, and when the market moves is in a direction where the equilibrium between the buyers and sellers is about to change. Excuse me. At the root of the Ichimoku technique are 5 lines, and we'll show you what they are one by one. These 5 lines don't mean ordinary moving average calculations, but they are in fact very similar to moving averages, and can even be applied as moving averages. As I state in the text, you can use them for price approximation. But the way they generate these lines, they look at certain number of periods. They look at a certain number of periods back, and instead of adding them together and dividing them by the number of periods, what they do is just look at the highest high that was achieved during those days, and then they just add those two together and divide by 2, and then take the middle point between the highest and the low of that day of that number of days. Number of days, the numbers that are particularly important is Ichimoku, in Ichimoku is 9, 26 and 52, and those were developed out of his team of people that this guy had working, and they seem to work the best. But until now they seem to work the best, but there has been some debate and ideas on the number of working days and weeks. They've been adopted but haven't been debated much, but you certainly can play with them and how you want to look into it. So on to the lines. The first line is called the turning line. It's also sometimes called a conversion line, and this one is a 9-day high-low line. What I mean by that is that it looks at the last 9 days and it takes the highest high and the lowest low that happened in all of those days, and it calculates the middle number. As you can probably see how it's got about right, and it's similar to a 9-day moving average, but it's a little bit jerkier because of the way it is developed. You know 9 days back if there's a high or low, and then you move forward a day, then in the line there would be a jerk. So it's more jerky than a moving average, but otherwise it acts very similarly. Rather. The second line, the standard line, is its usual name, but it's also called a baseline. So the first line is the turning line, or the conversion line, and that's the short-term line. The baseline or standard line, which I've drawn in blue, is a 26-day high-low average. So this is found by looking at the last 26 days at what's the highest high and what the lowest low, and we take the average. Look over here, we have a horizontal line, and the last 26 days from there, and you had a high and low and another high and low, and they dominate for a number of days until the line smooths out a little bit. So you can see how it's not very jerky line, but it's sort of like a 26-day moving average, and that's how in a way it can be used. Now we get to the interesting half of the Ichimoku technique. Now we get to the cloud line. The first one is called the leading span A. This one is shown in green color, and again I've made it thicker just to introduce it. This one is the average of the previous two lines, the 9 and 26 day, but it is moved forward by a certain period. If we look at the chart here, we've taken an average of the blue and the red line, which would be about there, but we've moved it forward 26 days, and there's our green line here. So the key to the Ichimoku is the kind of shifting thing, something you don't do in moving averages, and it seems to be what works the wonders. Leading span B is the other cloud line, and it's shown here as a sort of purplish line. This quite simply is a 52-day high-low calculation in the middle of the highest high and the lowest low in the last 50 days, but again it's pushed forward by 26 days. This is the important one, and I suggest that you make this one a little bit thicker than the rest of your charting software. It's the second line for the cloud. It's a 52-day high and low average, and it's shifted forward 26 periods. So the last two cloud lines, the leading span A and leading span B, are shifted 26 days forward. Now just look at the chart with the cloud filled in, and here's the little bit bearish. Normally wouldn't happen quite like this, and this is filling in between leading span A and leading span B. And when the leading span A is at the top, it's the short period line, so it's at the top and you're in an uptrend, and this particular colouring is sort of green blue to show you an uptrend. There's a bit of a downtrend, and there are a massive downtrend over here, so we've been changing over colours when there are landing line swaps, and that's a very important aspect of Ichimoku. You can look at the chart and you can feel what is happening. Moving on now, the fifth line we have. The fifth line is called the lagging line, and here it is a thick green. This one is not sort of any average, this is a price line, but it's moved backwards 26 periods. So the cloud is moved 26 days, and this is moved backwards 26 days, so effectively the time shift between the two of them is 52 days. And this one is quite an important line too. Now it's starting to look a little bit more complex, so we'll go to the lighter version where it looks a little bit less emphasized like this when you're actually trading. So how do we use this? We have a cloud, we have a thick line, we have a thick line, one border of the cloud, and a thin line, one border of the cloud. The cloud in general forms the support and resistance. It is most likely to be the thick line, the leading span B, which is most likely to be the resistance. But any part of the cloud can be, and quite often you will see, a price running along the edge of the cloud. As you can see here, it's running up the cloud, and it's running up the cloud, and here you can see its lagging line comes here and bounces off the top of the cloud, and then comes here and bounces off the bottom. But most of the time you'll see it pretty much bounces up here. Here it's following the bottom of the cloud. As you can see here, it dropped down in a downtrend there, but generally here we have it following the cloud going up, following the cloud going down. So the price of the lagging line tends to find support and resistance one side of the cloud or the other. We'll look at a different chart now. This is a cloud chart that's only a year long, that's been in a recovery. Here we can see it's in a strong uptrend. The price is a long way up above the cloud, but you do see that the price comes down, hits at the leading span B and bounces back up. And over here the lagging line hits and bounces back up, and over here the price hits, the actual drops through, but notice that it did recover and follows the leading edge of the cloud. Now this is the interesting thing with the Ichimoku, is that the cloud is pushed 26 periods forward. So you can draw 26 weeks worth of cloud before you even get there. And that means that if you're at this point, say now what is going to do in order for the trend to continue, well, it just have to stay a bit above there. This is, as you can see, a sort of downtrend coloured cloud, but it's very close, and it looks there as if it's just changing back to being an uptrend, but it's in a sideways trend. Now, like many technical indicators, you should be clear that clouds are really only work in a trend. So if that line you think you're not going to keep is going sideways, and that's what generates a cloud. But you can see on the cloud that's ahead of it, you can see which way the trends are going. But one of the important things for a cloud chart is to look at the different time spans. And here I have the time span for the Dow. Here it goes over a much longer period, and here it goes for 15 years, and you can see that it's very strong. This is what the cloud is showing here, that's October, it's going up to. So this cloud is in the future, but it's generated from a previous time span, but it's showing a very strong uptrend. It obtained from information from over here. Let me get another look at this. As we can see, there's some bouncing off the baseline of the Dow, and here's more bouncing. Here the lines are getting really closer, and what you really see happening is obviously it's somewhat sideways and then somewhat downtrend, more of a downtrend. But again up here it's basically bouncing at the bottom cloud line. Here, interestingly, it goes through, but it does come back up and follow the line forward, but it drops, and that is the financial crisis. So again, you can look for these aspects. Whether it's the lagging line or the price line, it bounces off the cloud, and what primarily engagement is actually when the lagging line comes through the cloud. It does tend to lag because it is late, and of course the lagging line can't be drawn until 26 periods. So some people use the line bursting through the cloud as a sign of a reversal. But it's more inclined to be more of a force sign than the lagging line. But the lagging line is waiting until it can give you some clue. So let's just summarize about what we've just said here. When the price is running above the cloud, the price is usually blue, or whatever color you've set for it, and it's above then usually, and it's usually a bullish market. And similarly, if the price is running below, then usually it's a pink cloud and it's a bearish or a downtrend market. Those are the two observations. When the price goes into the cloud, it depends which side it goes from. If it comes down into it from a bullish side, it's still regarded as a bullish market, even though the price is within the cloud. And similarly, if the price comes up from below, it's still regarded as a bearish market. But of course, when the price is in the cloud, there's always a chance of it to go through to the other side, and that would be the reversal. So you have to keep an eye on that. The cloud gives you support and resistance. We've covered that in depth while looking at the charts. I'll tell you to pull this up on your charting software and just go through. This one I haven't mentioned so far, thick clouds. They are wide clouds that show an accelerating trend. They're quite simple really. This is because the leading span A is running away from leading span B, so basically it's accelerating. But the opposite side of that is thin clouds, showing that the trend show that the trend could change. Now the primary signal is, as I said, in the lagging line crossing, but that may be a little late for you, and the alternate is that the price line can cross and give you a signal. What I suggest you do is look back historically from the chart and see what particular security is promising. Quite often the price line won't give too many false signals, and it will give you earlier signals for trade. So have a look at it and see price line giving false signals and going back up, but otherwise just choose which one seems to be working the best. And the last one, the changing color cloud, shows the trend change. You don't take that as a signal as such. You look for other signals for the trend change, and what I mean by this is that because the cloud changes color, that makes the trend change very clear. And that takes us back to the idea of facts at one glance. The Ichimoku technique is at one glance. And once you get used to it, you can just come through a lot at a glance and instantly see what's happening. The next module, Module 11, is a very important module, and it's on money management and computers. Computers, obviously, they have uses, and we'll go through that. Money management is the thing that really important. You should have and then you can have a mediocre trading system with good money management, and you can be happy and you will make money. If you have the best trading system in the world and you don't know what you're going to do with your money, you will go broke very quickly. So that would be the lesson that's emphasized next time. So I look forward to talking to you then.